Welcome to the Real Vision Daily Briefing. It's Thursday, February 17, 2022. I'm Ash Bennington, joined today by Jared Dillian of the Daily Dirt Nap. Let's take a look at U.S. equity markets right off the bat. Not a good day across the board. Looks like S&P 500 bouncing around a little bit, closing out down 2.12%. That's down to 43.80 right now. Big loser of the day, the biggest loser of the day, I should say, NASDAQ Composite off 2.88%, nearly 3%, closing out the day at 13,716. Dow Jones Industrial Average also off significantly, minus 1.78% on the day, closing out at 34,311. Gold price on the day, I think it's up about 1.5%. Close looking at right now like 1898, $1,898 per ounce on gold. Geopolitics once again in the headlines. U.S. Secretary of State Antony Blinken saying the risk of Russian attack in Ukraine remains, quote, very high. Secretary of State offering a meeting to his counterpart, Sergei Lavrov. Lots to talk about, lots of speculation about inflation and rate hikes. Couldn't be happier to have Jared Dillian with us today to talk about it all. Jared, welcome to Real Vision Daily Briefing.
Yo, how's it going?
Oh, it's going great, man. It's great to be back with you, dude. I miss doing these shows with you. So we haven't done these for a couple of weeks at least. Jared, what's on your radar in terms of the big picture, 50,000-foot overview of what's happening in these markets right now?
You know, I spent a lot of time looking at charts today, and this is what I think is going to happen over the next couple of weeks. I think we have a lot more downside in stocks. I think bond yields have topped. I think bonds are going to rip from here. We priced in too many rate hikes. We priced in 7 rate hikes. About half of those are going to get taken back. I think oil is going to correct significantly, and I think gold is going to continue up until about 1920. It runs into some resistance at 1920. But once you get through 1920, the next stop is 2060, the previous highs. And then after that, who knows?
Well, what's your time horizon for that outlook, Jared, as you talk about and think about gold?
I would say over the next 6 months. Once we get through the previous highs, it's going to be like a hot knife going through butter. The next stop I really think is 2,500 an ounce. And I think we could get there this year. I think that's very possible.
That's quite a call, 2,500 an ounce on gold this year. It's interesting, Jared, if someone had given you the inflation data points that we have seen print over the last, call it 60 days, and told you that gold would still be under 1,900, that would be a bit of a paradox. How do you think about that and how markets are pricing this inflation data, which has been pretty significant?
Yeah, I mean, I've been watching gold for a long time, and it didn't really respond to it went up a little bit during the pandemic, and it didn't really respond to inflation. So people got to a point where you just had this people threw in the towel on gold. They said it's useless. If inflation is 7.5% and gold's not going up, what am I holding this thing for?
Right.
But what you've seen in the past couple of weeks is a big reversal between crypto and gold. I mean, gold has gone straight up and crypto has gone straight down. I don't know if it was the last couple of weeks, maybe it's this week. But I think that's going to continue in the future. And the thing about gold is that it really, I would say more than any other asset, it follows the charts. It really follows the charts. If you look at, people look at money supply, they look at interest rates, negative interest rates, the budget deficit. And, all of this stuff has been screaming buy gold for the last 2 years and it hasn't worked. Well, it's going to work when it works, and you just got to wait for the chart to play out. And now that it has, I mean, this wedge pattern that gold has done over the last 2.5 years is one of the longest, strongest consolidations in any chart I've ever seen, which means that the next move higher is going to be very impulsive.
Yeah. So let me ask you also about these geopolitical tensions that we're seeing in Ukraine right now. How do you factor that into your models? How do you think about it, and how do you process it in terms of its implications for markets?
Well, in terms of the playbook I just gave you, was stocks going down and bonds going up and gold going up. I mean, all that, the charts are telling me that there will be an invasion, and I don't know how serious it's going to be. I don't know if Ukraine is going to fight back, or how many people are going to get killed. I really don't know, but I do think there's going to be an invasion, and I think that it was not going to happen during the Olympics because the Olympics are a time of peace. So I think it's going to happen after the Olympics. The end of the Olympics is on Sunday. So I think perhaps it could happen next week. So that's what I'm thinking.
Yeah. You mentioned cryptocurrency digital assets. Let's review a couple of these numbers here, particularly Bitcoin, trading right now at $40,993 on a trailing 24-hour basis. That's minus 7.2%. Ethereum trading at 2,909 24-hour basis, off 7.9% as well. It looks like that what we're seeing here is stocks correlated with digital assets rather than the safe haven play, which is something that you were alluding to earlier, Jared.
I think you mean crypto correlated with. Did you mean crypto?
Crypto and stocks. Yeah, crypto trading basically relative to stocks rather than as a safe haven play like gold.
Yeah, I mean, Nasdaq's down 3% today. It's the same stuff that's been happening for the last couple of months, ever since we put in the top in stocks. It's been all the unprofitable tech that's getting killed today. So yeah, I don't like. I take a long-term view on crypto. I hold some crypto. I have a portfolio of it, of a bunch of different stuff, and I used to sweat about it. When I first bought it, I was checking it like every 5 minutes, but I honestly don't even really look at it anymore. I'll check it in 5 years.
That's a very philosophical position. You mentioned the asset classes here. Let's take a look at stocks here by GICS classification. Precisely to your point, Jared, big loser on the day, information technology, minus 1.93%, so off nearly 2% on the tech stocks. On the flip side, energy up 4.7% on the day. So quite a dispersion there. After information technology, next biggest loser, communication services, minus 1.69%, and then consumer discretionary, minus 1.38% on the day, Jared.
Yeah, oil is due, energy is due for a correction. It's had just a fantastic run. And, I've talked to some people over the last couple of weeks, some people who work in the energy industry, and they're telling me that, oil is not done going up, and, they see $150 or $200 oil in the long term. But in the short term, I think you're going to get a pretty decent sized tradable correction. I think crude could go down to below 80 over the next couple of weeks. So we'll see.
Yeah. Let's take a look at crude prices right now, trading at 91.61 a barrel on WTI U.S. benchmark price out of Cushing, Oklahoma. I'm curious what you think about the natural gas space. Nat gas is something that we've been hearing about here in regard to the Ukraine situation. The United States is the first largest producer, the largest producer. Second is Russia. Natural gas here on NYMEX trading NG1 at $4.52, off about 4%, it looks like, here on the day.
Yeah, I don't have any specific thoughts on that, but I will say, the whole energy complex is due for a correction. So I think nat gas is going to go with oil in the short term.
And longer term, Jared?
Yeah. One of the things I keep hearing is that there's really not a lot of investment in E&P, even with oil prices at these levels. I mean, if you went back to 2014 and you had oil at $100, like, you had so much money pouring into the space for investment, and it's actually not happening this time. And it's not happening because of ESG and the cost of capital is high. So I think the price has to go higher in order to attract that investment. So long term, I think it's actually kind of scary with regard to oil. I think in the long term, it could be pretty ugly.
Yeah. Just to unpack some of the acronyms here for people who don't follow energy markets as closely as you do, E&P, of course, is exploration and production. This is the early stage development of natural gas, oil, and other assets in the resources space. And ESG is environmental, social, and governance, the trend that we've seen toward wanting to reduce the carbon footprint of the world. And so you see these trends, precisely as you say, playing out with an absence of exploration and production, funds being committed, resources being committed. There's just simply not happening at the rate that you would expect given this market due to the social pressure from the ESG side.
Yeah, I mean, ESG is, I would say, probably about 60% responsible for the oil prices that we are enjoying today. So,
Jared, how do you come up with that weighting, by the way? What makes you say 60%?
I just pulled it out of my ass. I don't know.
Sounded great. You can just pull it out of your ass, Jared. This is years of watching these markets, the intuitions you've built up about this sector. I also, something that you said earlier about the Fed and rate hikes, boy, I think you're spot on there. And I wanted to actually take a look at a clip here that we ran on Real Vision today, a conversation between Alfonso Peccatiello and Jim Bianco talking about precisely that point. This is from a piece called Fed Rates, Inflation and Recession. Actually, I should say it ran yesterday on the Plus and Pro tier here at Real Vision. Let's take a look at that clip right now.
In 2015, they started raising rates, and all the way through the end of 2018, they raised rates to 2 3/8, broke the repo market in September of 2019. At every stage, it takes a lower and lower level to get to the point where you invert the yield curve and you break something. So when I look at the terminal funds rate at 175 or 2, I get the argument, that this is a sign that inflation's going to come down, the Fed's going to be gradual, everything's going to be okay, stocks go to 5,300 while inflation is on its way down, and it's all going to be good. I look at it and say, what that means is 6 rate hikes this year, 2 more next year, and we'll be on breakage watch. That's all you're going to need to basically invert the curve and break something. And why? $30 trillion of debt, a highly levered economy, highly levered financial markets. I hear the Dudleys of the world say, no, we might have to take funds rate, way above the neutral rate to like 4 or 5%. We're never going to get to 4 or 5%. We're going to have a complete mess on our hands long before we ever got to that kind of a rate. To try and rein in an accelerated inflation. We'll go to 2 and we'll break things, and then demand will slow, inflation will come down. The Fed will say, see, we fixed inflation. Yeah, you fixed inflation by causing a recession. That's the, my other analogy in that was like, I go to the doctor and say, I've got an infection in my leg, and he pulls out the bone saw and says, it works every time. And I was like, well, that's kind of not the way I wanted you to fix my infection. Well, that's the way the Fed is. You want to get rid of inflation? We'll just crash the economy. There you go. No more inflation.
Jim Bianco says it so well there, talking about the balance of risk between inflation and recession. Jared, give us your sense on what's happening with federal funds rate, how the FOMC is thinking about this economy, and what that balance of risk looks like in your analysis and assessment.
Well, one thing you have to remember is that there's still the Fed is not unanimous in calling for rate hikes. I mean, there's a lot of Fed members that are dovish. I mean, we saw Mary Daly, I don't know if it was this week or last week, but she wanted to hike 25 and then pause. And there's other people on the Fed who don't want to hike 50. And I really, I look, this is my call. I think the Fed's going to hike 25 in March. I don't think they're going to do 50. I really don't. Look, I was a big proponent. This was months ago. I said, the Fed is behind the curve. They're embarrassed. I was talking about Fed embarrassment. I said they've been embarrassed by this inflation. They're going to hike a bunch of times to catch up. Powell is concerned about his legacy. But at the end of the day, it's not unanimous within the Fed, and I don't think they're going to do it. So I think at most we might get 4 rate hikes this year, maybe less than that. So I've totally changed my tune just in the last week or two.
Yeah, and does that suggest, Jared, this perception that markets simply cannot handle 50 basis points, that the U.S. economy simply cannot handle 50 basis points?
No, I think that perception exists. I mean, it absolutely exists. But I don't think it's true. I think the market can handle it just fine. I mean, really, like, the only time in recent history, and I say recent history, the last 50 years, that a Fed rate hike cycle crashed the market and caused a recession was in the early 80s. And like every other time, I mean, even in 1994, the Fed started hiking in February of 1994. They hiked about 2 or 3%. I don't remember the exact number. In the bond market, it caused a lot of problems in the bond market, but stocks really didn't go down that much. So the market can absolutely handle a 50 basis point rate hike, can handle a lot of them, but we have this perception that it can.
Yeah, it's interesting, sort of basis for comparison. You're talking about a period when I think September 1981, 10-year Treasury yields were at over 15.5%. Imagine that.
Yeah, I mean, it's in the short term, I think bonds are going to do very well. Let's put it that way. I think it's going to surprise a lot of people. I think you could get 10s back to 1.6 by the middle of March. I think that could happen.
Hey, Jared, do me a favor. Unpack that logic, that reasoning for people who are relatively new to the fixed income space, who are just thinking about this in terms of equity markets. That's a pretty striking call. U.S. 10-year Treasury yield at 1.6%. Give us a sense of what that means and how you're getting there.
Well, really, how I'm getting there is with sentiment. I mean, the Treasury market operates on sentiment just like stocks do. A lot of people think bonds are rational, they're mathematical. Nothing could be further from the truth. So I mean, here with 10s, around 2%, people think, okay, like rates are going to go to 2.5, mortgages are going to go above 4. It's going to choke off the economy. Like, people are telling these stories, and just when everybody goes to one side of the boat, then they go the other way. So this is just a short-term call. This is just over the next 2 to 4 weeks.
Yeah. If you've ever spent a Thursday night out with bond traders, you know that they're not math professors. They definitely. I'm looking at the comments here. I just saw Matt Hayes wrote, "There's no gold like gold," and that really is the sentiment we're seeing being priced into markets today, with gold and the relative differential in terms of daily trade action on cryptocurrency.
Yeah, I mean, look, I've greatly increased my gold holdings, and it's my biggest position, and I have that much conviction on it. I know it's funny because I have a portfolio full of crap. I have a bunch of stocks that I don't really have strong feelings about. But this chart in gold, this breakout is one of the most powerful breakouts I've ever seen. And the interesting thing about it is that, as I read through the comments on Twitter, like, not that many people believe it. They're like, "Oh, I'm just going to wait for another opportunity to short it." I'm like, guys, have you seen the chart? Have you seen the chart? It's a thing of beauty,
Yeah. Lots of questions coming in right now to us, Jared. Any other topics you want to hit on before we switch over to questions?
No, let's do questions.
Great. So here's a question from Ralph Humphrey. This is a fun one. I don't know about this. I'm curious to get your thoughts on it. It's from the RV site. Can Jared elaborate on his thought that Warren Buffett tells people to do the opposite of what he preaches?
Yeah, I tweeted that out a couple days ago. So I guess Buffett has invested in a Bitcoin exchange startup. I can't remember the details, but of course,
Brazilian neobank, right? Was that the
something like that? Yeah. But Buffett, he says everybody should be in index funds and hedge funds suck, and he runs the biggest hedge fund in the world. Like, he said for 20 years that airlines were terrible, that they should have shot down Orville and Wilbur Wright, and then he invests in airlines. By the way, 3 years too late. He was like, he did it in like 2016. He should have done it in 2013. But he does this all the time. Like, so don't listen to what Buffett says. Like, watch what he does. Watch what he does.
Here's a question that comes to us from Achilles from The Exchange. This is Real Vision's internal social network. And the question for you, Jared, is what sectors are you bullish on for 2022?
For the whole year, it's kind of hard to look out that far. I mean, I said energy is going to have a pretty big correction, but I think energy still could be the top performer for 2020. Although I will say that over the next couple of weeks, I think we have about 10% downside in stocks, and I think the Nasdaq's going to get hit worse. There's going to be a buying opportunity in not Nasdaq broadly, but a lot of these unprofitable tech. I mean, they're really getting down to bombed out levels. So I think in a couple of weeks, 2 to 3 weeks, you might have an opportunity to take a shot. Some of the Cathie Wood names, that's what we're talking about here, the Cathie Wood names. So.
Yeah, I mean, talking of Cathie Wood names, I think Zoom is off about 50% from its highs. How do you know when these start looking like buying opportunities?
It's kind of gut. It's a good question. I don't know. It's really subjective. I did see an interesting chart today. Michael Batnick over at Ritholtz, he posted that he put up a chart of Zoom and ExxonMobil, and at one point last year, Zoom was worth more than ExxonMobil, and now ExxonMobil is worth 10 times more than Zoom. So,
I mean, that's just a crazy ratio, right? I mean, if you just look at the gross revenue that those companies generate, the differential is just extraordinary.
Yeah. I wish I had seen that chart last year. Let's put it that way.
Very well said. Very well said. Hey, listen, I wanted to come back to gold because I know it's something that you've been thinking about. How do you own gold, Jared? What do you think of the miners? What do you think of the complex in general? And relative to the physical commodity itself, for example?
I mean, it's a combination of the ETF and the miners. I mean, here's a story. So back when I was, running the ETF desk at Lehman Brothers, there was a guy that came by from the World Gold Council. His name was Stuart something or other, and he was with a guy from State Street, and they wanted to start this gold ETF, and this is like 2004.
Yeah.
So I sat in a conference room with this guy, and he pulled out a 10-ounce bar and put it on the table, and he gave it to us, and you could hold it, and he says, "This thing is worth $6,000." And of course now it's worth $19,000, right? But anyway, so in order to launch the GLD ETF, we had to sign on as an authorized participant. So I had like 500 pages of documents I had to read through and stuff like that. But we were one of the first banks to sign up as APs. And I was, after reading all this stuff, I was like, this is such a great product. As soon as it went public, I immediately bought some for myself. And I have not sold it in 17 years. I still have it.
So I have a question for you, Jared. Was that guy George Milling Stanley from State Street, who was actually just on Real Vision, I think, yesterday?
Could have been. I don't remember the State Street guy's name, but could have been.
Yeah, he's a really interesting guy. I've had the pleasure of interviewing him myself, and he has really interesting insights and thinks about this in a very deep way in terms of optimal portfolio balance, at Sharpe ratios, and some other attributes of investing in gold. It's a great interview if you haven't checked it out on Real Vision. He's actually on with, I think, Rick Rule, I believe, who's obviously a very well-known name in the gold space. Lots of questions, Jared, keep coming in. Here's one from Hannah F. from The Exchange. This is a really interesting one. Once the Fed winds down the purchasing of mortgage-backed securities, who's going to buy all that MBS?
I don't know. I think the private sector can absorb it. There's mortgage mutual funds, pension funds, stuff like that. Like, I for sure mortgage rates are going to go higher. I would say, and I'm going to pull something out of my ass again, but I would say that the Fed buying mortgages has probably lowered mortgage rates by 30 or 40 basis points. So you will see mortgage rates go up. Not egregiously, but
yeah. Some more comments coming in. They're actually flowing in so fast, it's tough to follow them. Here's one that comes to us from Inyasi from YouTube. Hello, what's Jared's opinion on Russia? Perhaps the cheapest stock market in the world, extremely low valuations with very low debt levels. I don't know. Do you have the stomach to get into Russian equities at this moment?
So I actually bought RSX, I want to say 2 years ago, and I didn't have any patience with it, and I sold it. There's absolutely going to be a good time, and maybe it's after the invasion, assuming the invasion happens. Maybe it's 2 weeks, 4 weeks after the invasion. I mean, yeah, Russia trades at a big discount for a good reason, but talk about cheap stocks and big dividends and exposure to energy and EM. I mean, it really has a lot of things going for it.
Interesting. While we're talking international, here's a question that comes to us from Daniel Wajkowski from Real Visions Exchange. And the question is to you: what do you think of the thesis for going long China because they are easing into what looks like a pickup in credit growth, while the U.S. will likely be hiking in a slowing growth environment?
I mean, I just, as a general rule, don't touch China. But that is kind of interesting. I mean, look, like in one of my newsletters, I have an EM fund, but it's an EM ex China fund. Um, it's the ticker is FRDM. It's the Freedom Weighted Index. I don't know if you heard of that ETF. It's pretty interesting, but it basically leaves out all the bad human rights actors. So it's not just China. It leaves out Russia and stuff like that. And that ETF, I would say over the last 4 or 5 months has outperformed EM by a lot. So I don't know if that performance is going to reverse. I really don't. I just don't have an opinion.
Yeah. What is it about China that makes you not want to get involved with it? Is it transparency in the data issues, or there's some other?
It's a transparency in the data issues mostly. I mean, I remember when I was at Lehman, and this is in the mid 2000s, and China's GDP was printing 8.0% quarter after quarter after quarter. And we're like, what the hell is going on? I mean, this is like Madoff, it's like Madoff's returns. And I mean, it was because 8 was a lucky number. And I'm like, this is a joke, like how can anybody analyze this? So people at the time, I mean, this is the mid 2000s, people were looking at like electricity usage to, numbers that you can't fake to
Right.
determine GDP growth. So I can't do it.
Yeah, one of the great interviews that we've done at Real Vision is, and I'm blanking on his name at the moment, is the gentleman who runs China Beige Book, who does the analysis on exactly those questions that you were talking about, things that you can't fake, like electricity, and some of the other aspects that you can get some transparency on without relying necessarily on the state-sponsored data.
Yeah, I would love to. I'm really interested in that. So let's talk afterwards. I want to learn more about that.
Yeah, that would be fun. Maybe we'll get you guys on together.
Yeah.
So, Jared, as you look out to the future here, what are you looking for over the next, say, 30, 60, 90 days with regard to markets, Fed rate policy, which I think you've already talked about a little bit, and just the general outlook that you have for this investing environment?
Well, like I said, I think things are going to get a little untidy over the next couple of weeks, probably because of the imminent invasion. I think it's going to get a little bit ugly, but I never believed that this correction would turn into a 2008, a a 50% down correction. I never really saw that. I've the whole time I've been thinking that this would be about a 20% correction, and that would represent a really good buying opportunity. So I think that is actually going to play out.
Yeah, well said. By the way, Jared, you know what's cool about doing this show? In the YouTube comments, Mick Z told me Leland Miller, before I could Google it, Leland Miller, of course, runs China Beige Book, a great interview, a number of great interviews, I should say, here on Real Vision. Jared, as we come to the conclusion of this conversation, final thoughts, key takeaways that you'd like to leave our audience with?
Yeah, I mean, I think there's still a lot of complacency out there. The initial decline, which has been, I think we're down about 8% or something like that from the highs. The decline has been pretty orderly. When you saw stocks decline, you really didn't see vol spike. You really didn't see the skew get expensive. Credit has widened a little bit, but certainly not to panic levels. So this has been a pretty orderly decline, which leads me to believe that the next leg down is going to have an element of panic to it. Okay. And which is good, which is absolutely good. That's opportunities, but that's what I think is coming next.
And how will you know when that trade is in? What would you be looking for in terms of panic? What would it look like?
I mean, it was a Monday. I don't remember the date, but we had, the day that we had where we were down 4% and up 4% in a single day. It was on a Monday. Do you remember that an intraday move? Like that's the type of price action I want to see, like 4, 5, 6% moves in the index, VIX above 40, stuff like that.
Yeah. Jared crisply said, thank you again for joining us. Always a pleasure to do this show with you.
Oh, thanks a lot.
And thanks for watching, everybody. Great questions. Maggie will be back tomorrow with Christian Alexander on Real Vision Daily Briefing. As always, the conversation continues on the exchange. Thanks for watching.